Hello everyone, as I am audible to all of you and I am visible. Good morning everyone. Good morning everyone. Welcome to today's class. So today we are going to start our module D, balance sheet management, and in this we will see all the MCQs and the concepts related to the MCQs. So I hope I am visible to everyone and audible to everyone. So good morning everyone. So in a few seconds or few minutes we are going to start our today's lecture. Okay. A very good morning everyone. So yeah, this is our bank financial management module D. Already we discussed module C, module B, and there are so many videos related to module A. MCQ questions are there also in this channel. You can go and find out, like that video and also like in this video. Do comments, and yes, let's get started with our first question. Okay, so we will see the concepts here, we will see the right answers here, we will understand the different concepts meanings. So first question is, which one of the following is a source of funds in the balance sheet of banks? So you all have to give the answer, so and make this session very interactive. Which one of the following is a source of funds in the balance sheet of banks? Four options are given here. Balances with RBI, advances made to AAA, that is triple A rated corporate, deposits accepted from general public, and SRR compliant investments. So if we know about, if we see, uh, there is the first option, that is balances with RBI. Basically, these are the reserves that banks must hold with the RBI. Okay, this includes both the cash reserve ratio and the statutory requirements, and bank here must maintain a portion of their deposits with the central bank, that is RBI, to ensure the liquidity and the stability in the banking system. And the RBI regulates this to control money supply and inflation. And if we talk about here advances that are made to triple A rated corporate, these means when a bank makes the advances, that is basically loans and credits to a corporation, or triple A rating indicates the highest level of credit worthiness. And triple A rating implies that the company is highly unlikely to default on its debt obligations, and lending to such companies is considered as low risk for the banks basically. Okay, then here third option is given. Third option is given here, deposit accepted from the general public. Okay, so what is the meaning of this? Deposits accepted from the general public. See, these are the funds that individuals and businesses deposits into the bank, either in saving account or current account. Okay, or we can say in the fixed deposits too. And basically banks use these deposits to making to make basically the loans, okay, while offering interest to the depositors in return, and they are an important source of funds for the bank. Then SLR compliant investments. Basically, this is stands for the statutory liquidity ratio, and it is the percentage of a bank's net demand that and the time liabilities, that we can say that NDTL, that must invested in specified government securities, bonds or other approved securities, those basically who satisfy the regulatory requirement of deposits in liquid in banks deposits. And this requirement is basically mandated by the RBI to ensure the solvency and liquidity of banks. So here question is asking about the source of fund. So our option C is correct, with that is deposits which is accepted from the general public. Okay, so answer is option C. Then moving to the next question, here is the what is the feature of notice money market? What is the meaning of notice money? Can anybody tell me what is the meaning of notice money? What is the meaning of notice money? Okay, so see, if we see the example of notice money, what is the meaning of notice money first? Notice money market is the segment of the Indian money market. Okay, it is a segment of Indian money market where short-term funds are borrowed and lent for a period which is ranging from 2 to 14 days, and it is a key part of the interbank lending market where financial institutions trade liquidity to manage their short-term needs. Okay, so notice money market, in this market funds are transacted between 2 to 14 days. Okay, so our option A is correct there. In this markets, funds are transacted between 2 to 14 days. Next question. What can be described as the ALM, that is asset liability management? And I hope everybody is knowing the meaning of ALM. If you don't know the meaning of ALM, then I will tell you. What is the meaning of ALM? What is ALM basically? It is a strategic framework, yes, and it is basically used by the financial institutions. Financial institutions such as banks and the insurance companies to manage the balance between assets, whatever the deposits and borrowings, and the liabilities, that are deposits and the borrowings, with the goal of minimizing risk and ensuring the liquidity and the profitability. Okay, so if we talk about here, what can be the best description of asset liability management? It is that asset liability management is the act of planning, acquiring and directing the flow of funds through an organization. So here we can mark our option B is correct, that is ALM is the act of planning, acquiring and directing the flow of funds through an organization. Okay, so you can also give the answers, you can also do the comments. So I will see who know the answer or who is here. Okay, so make the session interactive, give like And yes, also comment and subscribe to this channel. Okay, so now it's time to move to the next question, that is, how can the net interest margin be understood? Net interest margin be understood. Okay, if we talk about NIM, it is a basically key profitability that needs for the bank, and it is a profitable metric for the banks or other financial institutions. It represents the difference, and it represents the difference between whatever the interest income earned on the assets such as loans and investments, and the interest whatever paid on liabilities such as deposits, borrowings, expressed as a percentage of the interest earning assets. Okay, and if someone is asking the formula of NIM, what is the formula of NIM? That is equals to interest income minus interest expense, then it is divisible by average earning assets multiply by 100. Okay, so if we talk about the correct answer, that is the answer is correct, which is spread on earning assets. That means our option D is correct here. Okay, how can the net interest margin be understood? Spread on earning assets. Okay, so next let's move to the next question. Here the question is asking, tier 2 capital is restricted to dash of tier 1 capital. Tier 2 capital is restricted to dash of tier 1 capital. So here the answer is clear, that is of 100%, because tier 2 capital is restricted to 100% of tier 1 capital. This means we can say that the amount of tier 2 capital that basically a bank that basically we can say that a bank can have and is capped at an amount which is equal to the tier 1 capital, and this is in line with the Basel third framework, which sets the guidelines for the capital structure of banks to ensure the financial stability and the risk management. And tier 1 capital is considered core capital such as equity and retained earnings, while tier 2 capital includes some type of supplementary capital like subordinated debt and hybrid instruments. And also tier 1 capital or tier 2 capital, both are two categories of regulatory capital in which banks must maintain to ensure that they can absorb the losses, and as well as they are ensuring that they can absorb losses and they remain solvent. Okay, so here we can say that the correct answer in this option B, that is of 100%. Now, how is any capital requirement which is arising from the credit and counterparty risk which are to be met? How is any capital requirement arising out of credit and counterparty risk to be met? So can you tell me first what is the meaning of credit risk? See, credit risk basically it refers to the risk that a borrower will fail to repay a loan or meet contractual contractual debt obligations. Okay, and it is the risk basically which are faced by lenders, investors, or banks in all types of lending and borrowing arrangements, including bonds, loans, and credit lines. Then if we talk about the counterparty risk is basically is the subset of credit risk, and it refers specifically to the risk to the other party in the financial transaction and will not fulfill its obligation, and it is mostly associated with the derivatives, and we can say trading and investment contracts. So the correct answer in this is it is the done by the tier 1 and tier 2 capital. Okay, then what is the recommended principle for ICAAP formulation, and what is the meaning of ICAAP? We know that what is the meaning of ICAAP, that is basically internal capital adequacy assessment process, right? Now it is a key component of the Basel II and Basel III frameworks, which requiring banks to assess and manage their capital adequacy in relation to their risk profiles. And the ICAAP formulation is a comprehensive process that basically helps bank identifying, measuring, monitoring and managing all the material risks and ensure that adequate capital levels are maintained to cover these risks. So here, what is the recommended principle here? We can say that it encompasses firm-wide risk profile. So option C is correct here. Okay. So now, are you able to know what is the meaning of ICAAP also? Okay, so yeah, do comments and yeah, give like to this video. Okay, moving to the next question. What is the scope of disclosures under pillar third? If we are talking about pillar third disclosures, these are crucial for maintaining the transparency, and basically it enables market participants to assess a bank's risk profile effectively. While individuals units may provide information, and the primary focus of pillar third is on the consolidated level of the banking group to which the capital adequacy framework applies. So if we say that it is the applied on the top on consolidated level of the banking group to which the capital adequacy framework is applied there. Okay, that means clearly we can say that this consolidated approach ensures that stakeholders have a comprehensive understanding of the bank's overall risk and capital management practices. So our option B is correct here. Okay, moving to the next question, that is the disclosure of capital requirements for credit risk fall under which category? So option is qualitative disclosure, analytical disclosure, principal disclosure, quantitative disclosure. So let's talk about first what is the meaning of qualitative disclosures. Qualitative disclosures basically focuses on describing the bank's policies, and also we can say the processes and the government related to the risk management and capital adequacy. This disclosure provides context and insights into how a bank manages risk and the rationale behind its strategies. Then we will talk about what is the meaning of quantitative disclosure. It provides the quantitative means providing the data in numerical format and the matrix that basically enables stakeholders to assess the bank's capital adequacy and risk exposures. Then we will talk about the principal disclosures. These disclosures basically we can say that refers to that disclosures in which the core information like banks are required to disclose under pillar third to meet the regulatory requirements, and these disclosures encompasses basically qualitative and quantitative both disclosures because they are focused on significant risk and capital adequacy. And also analytical disclosures basically involves use of matrix and ratios and other analytical tools which access and compare the bank's performance and risk profiles. Okay, and basically here these disclosures helps in benchmarking against peers of the bank's risk management strategies. And also we can say that in this the correct answer is option D, that is quantitative disclosures. So I hope everything is visible here. Okay, now moving to the next question here. Okay, so here let's see. I hope it is known to you that disclosure of capital requirements for credit risk falls under the which category, that is the category of quantitative disclosures. Okay. Now banks should not charge and take to income account interest on any NPA. What is the exception here? What is the exception? Can anybody tell me what is the meaning of NPA here? That is non-performing assets. Basically, it refers to the classification which is used in banking to donate a loan or advance that is default or arrears. An asset is become non-performed when the borrowers fails to make interest payments or principal repayments for a specified period. Typically we can say that 90 days. It is vary by the jurisdiction or regulatory framework, and NPAs are a significant concern for the banks as they affect the financial health of the institution. So here we can say that the correct answer in this case, if interest on advances against the term deposits may be taken to the income account on the due date, provided here adequate margins is available in the accounts. So bank should not charge in this exception. So this is the C option correct here. Okay. How is significance in the erosion in the value of security reckoned? See, what is the erosion in the value of security? Basically, if the erosion in the value of security we are talking about, it refers to the decline in the market value, or we can say market value of collateral or assets that lender or financial institution has accepted to secure a loan or credit facility. Okay. Basically, in this we can say that this concept is particularly in investment and the risk management, and in the case of decrease the it basically decreases the value of the security that can significantly affect the lender's ability, in which we can say that it is unable to recover the loan amount in the event of default. Okay, so if we talk about what is the significance, how is the significance in the erosion in the value of security reckoned, so we can say that when the realizable value of the security is less than 50% of the value which is assessed by the bank or accepted by the RBI. What is the provision to be made as per the rules for the loss asset of 10 lakhs? Basically, this is clear. The provision that is made to uh, to a loss asset for a rupees 10 lakhs is rupees here 10 lakhs, because we can say that there are non-performing assets where there is no security or where the realizable value of the security is considerably eroded, and therefore we can say that for a loss asset the RBI mandates a 100% provision, meaning that entire its outstanding amount must be set aside as a provision. So we can say that here 100% is 10 lakh, that means option D is correct here. Okay, that is the provision. So RBI is mandating this thing. The next question is, how is provisioning ratio defined? Okay, just take an example here. If for example okay, if imagine you are running a bank, that is your bank, okay, a very good bank, and you have given us several loans to different types of businesses. Some of these loans start showing signs of trouble. Companies are struggling to pay back what they are owing. As a responsible banker, you need to set aside money to cover all the potential losses, which is called provisioning. As a banker, as a responsible banker, you need to set aside money to cover the potential losses, which is called basically provisioning. So here we can say that the answer is ratio of provisioning to gross non-performing assets is called, we can say, as the provisioning ratio is defined. Okay, and also provisioning ratio is to measure how much you are setting aside. You use something called the provisioning ratio. Okay, understood? And you can use in this this is the example, this is basically provisioning ratio is defined. Now let's talk about which of one of the following constitutes element of funding risk here. So first we must know the meaning of funding risk. What is the meaning of funding risk here? So see, if we say about funding risk, that this refers to the potential that an organization, particularly financial institutions such as banks, unable to secure the necessary funding to meet its needs, and this risk can arise from various factors which are including market conditions, liquidity issues or regulatory charges. And liabilities in foreign countries means there are financial obligation that an organization has in foreign currency or that can arise from the operations in a foreign currency. severe deterioration, and we know that what is the meaning of swaps. Swaps are basically are the financial derivatives that flows or other financial instruments over a specified period. And basically options are we can say that options are that contracts that give the holder the right but not the obligation to buy or sell an underlying asset at a predetermined price with a specified time framework. So here the option D is correct, that is option A is correct, that is liabilities in foreign currency is the element of funding risk. Okay. Then what is the reason for complexity in liquidity management for banks with international presence? If we talk about the complexity of liquidity management, what are the complexity in the liquidity management for the banks with an international presence arises primarily due to the various factors which are associated with operating in multiple jurisdictions. And here whatever the options are provided in this, we can say that in the event of a disturbance, a bank may not always be able to mobilize domestic liquidity to meet the foreign currency funding requirements. So here this option is correct. Why this option is correct? What is the reason to behind this option is correct? Basically, this is the key reason for complexity. If there is a sudden need for liquidity in foreign currency, economic issues, bank may find it challenging to access sufficient liquidity from their domestic operations. And these challenges basically arises from the currency mismatches and the regulatory restrictions in different types of jurisdiction. So here option B is correct. Okay. Next question. Measuring and managing funding requirement can be done through two approaches. One is a stock approach, and what is the second one? What is the second one? So let's talk about here. First, what is the meaning of regulatory approach? Regulatory approach is basically managing the funding requirement which are based on regulatory guidelines and requirements, but it is not considered as a primary approach like stock and flow. If we talk about the analytical approach here, analytical approach is like that approach, basically we can say that it is like in which the analysis is done, that is called analytical approach. But if we talk about here the flow approach, in flow approach is basically emphasizes the changes in funding requirements over the time. And survival approach is basically, we can say that this approach is focused on the amount of funding that a bank or institution needs to maintain its operation at a specific point in time. So measuring and managing fund requirement can be done through two approaches. One is stock approach, and which one is second? Second is flow approach. That means our option C is correct here. Now, which one of the following ratios should be higher for better liquidity management? As we know that what is the meaning of liquidity management? It is basically the process where all the financial institutions and businesses ensures that they have sufficient liquid assets to meet the short-term obligations while maximizing returns on their investment. And it is a critical aspect of financial management that involves monitoring, forecasting, and also managing cash flows, as well as maintaining an appropriate balance between liquid and illiquid assets. So here the ratio of core deposits to total assets is the correct answer in this case. Okay, moving to the next question. Yeah, what is gap or mismatch risk? Can anybody tell me what is the meaning of gap and mismatch risk? If we talk about gap or mismatch risk, it is refers to the potential or financial loss which is arising from the differences in the timing of cash flows which are related to assets and the liabilities. And this is the that risk which is particularly relevant in the context of interest rate risk management, as it can significantly affect an organization's profitability and the liquidity. So here clearly we can say that our first option is correct, in which a gap or mismatch risk which is arises from the holding assets and liabilities with different principal amounts, maturity dates or repricing dates, therefore creating exposure to changes in the level of interest rates. Then what is basis risk? See, if we talk about basis risk, it is type of a financial risk that arises from the imperfect correlation between the price of a hedging instrument and the price of the asset that is being hedged. This is basically that discrepancy which lead to the potential loss when the hedging strategy does not perform as expected. So what is the basis risk? This is that risk in which the interest rate of different assets and liabilities may change in different types of magnitudes. What is embedded option risk? Embedded option risk basically refers to the risk with the presence of embedded options in financial instruments such as bonds, loans, or the derivatives. And basically an embedded options gives the holder certain rights such as the ability to convert, redeem, or under specified conditions, and this can significantly impact the cash flows and the valuation of the instrument, making it essential for the financial institutions and the investors which can manage the risk effectively. So here we can say that the correct answer is the risk of premature withdrawal deposits and prepayment of advances is called embedded risk option. Okay. Now what is a crucial assumption in bond pricing formula? See, if we talk about the bond pricing formula is always dependent on the financial strength of the buyer. See, while the credit worthiness of the bond issuer does not affect the bond pricing, so it is not a primarily assumption, and the bond pricing can be manipulated to suit the convenience of the seller. This statement is also we can say that incorrect. If we talk about the third option, bond price rise when the interest price rise, this statement is completely incorrect. Next statement, all coupon payments are reinvested in the bonds yield to maturity. Yes, this is the correct assumption because the bond pricing formula assumes that the all coupon payment receipts are reinvested at the same rate as the yield to maturity. This assumption is essential for calculating the present value of future cash flows accurately, as it impacts the total return on investment we received from the bond. So here option D is correct. Okay. So yeah, moving to the next question. I think basically there is 20 to 25 questions are there in this module. Very short module and very easy module, but yeah, we can't, that is easy, that does not mean we have to uh, ignore this module. So yes, Sureen sir, you are correct. You are giving the answers correctly. Very good to you. I saw the comments now, so that's why I'm not responding. But yeah, I saw your comments. Very good. Good morning also. So, moving to the next question. Now, while expected the loss, which are covered by specific reserves and the provisions, how are unexpected losses are handled? If we talk about unexpected losses, in the context of banking and the credit risk management, it refers to the losses that exceed the expected losses. Okay, due to some type of unforeseen circumstances. Now, the correct interpretation of unexpected losses are, we can say that, through capital allocation based on confidence level, time horizon, and diversification and the correlation. Why? If we talk about here, so basically, we can say that due to capital allocation and here we can say that it reflects the potential losses that can occur beyond what is predicted based on historical data, and financial data need to hold economic capital to cover these uh, unexpected losses, and ensuring they remain solvent and can absorb losses in adverse conditions. Okay. Yeah, 23B, correct answer, Sureen sir, very good. Now, moving to the next question, the pricing of product should provide a buffer against losses, expected losses. What do unexpected losses indicate? If we are talking about the pricing of product which provides a buffer against unexpected losses, so here we can say that unexpected loss is a measure of amount of capital, as I already told you, it is a measure of economic economic capital which is required to support the bank's financial risk. So unexpected loss is a measure of the amount of economic capital which is required to support the bank's financial risk. Option C is completely correct here. Yeah, 24th C, very good. So now we are almost on our last question of this module. How is risk adjusted performance called? Defined, we can say also. See, if we talk about risk adjustment performance, it is a measure in which it is used to evaluate the measure, or we can say it is used to evaluate the return on investment or the performance of an asset while consider the risk associated with it. And here if we talk about the total, the correct statement is profit for each unit of risk capital, because here this statement, basically we can say that here the correct answer is profit for each unit of risk capital. This is the correct answer here. Okay, because risk adjustment process is a measure which is used to evaluate the return on investment on performance of an asset, while we can say that it considering to the risk associated with it. Okay, so here the correct answer is option D. So basically, uh, we completed our module A, module B, module C MCQs and module D. Okay, and yeah, we will start now with different things on the upcoming sessions. So I hope today's lecture is understandable by all and it helps you in learning some things and also revising the things. So if you like this video, if you like today's session, you can give the comment and also like this session. Thank you so much for joining today's session and have a good day all. We will meet in our next session. Thank you sir. Thank you everyone.